Ever wondered how startups get their initial funding? It's a question that's been at the heart of many successful business ventures. You see, a startup is more than just a great idea. It's a journey, a process, a complex dance of creativity, innovation, and business acumen. But even the most brilliant idea needs fuel to ignite. That fuel in the business world is funding. It's the lifeblood that takes a simple concept from the drawing board to the marketplace. Without it, even the most promising startups can sputter and die before they've even had a chance to shine. This initial funding, often referred to as seed capital, is a crucial step for any startup. It's the springboard that propels them into their future, helping them to develop their product, hire their team, and establish their brand. This brings us to a special group of people called angel investors. But who are they? Angel investors, as heavenly as they sound, are individuals who provide capital for startups in exchange for ownership equity or convertible debt. Now, these are not your average investors. They're often successful entrepreneurs themselves who have a keen eye for innovative ideas and the potential to disrupt the market. They play a crucial role in the startup ecosystem. By injecting essential funds into early-stage companies, they help fuel growth and innovation. Unlike venture capitalists, who usually represent a firm or a pool of investors, angel investors invest their own personal funds. But here's the catch. They typically invest in high-risk, high-reward startups, hoping that one of their investments will become the next big thing. They're not just money bags, though. They often provide valuable mentorship, industry connections, and strategic guidance to the startups they invest in. So while angel investors do need a hefty bank balance, they also need a good understanding of business, a willingness to take risks, and a passion for innovation. There's more to being an angel investor than just having money to invest. Angel investors are not just throwing their money around. They look for certain things before they decide to invest in a startup. And what are these things, you may wonder? Well, the first thing that catches their eye is the potential for high returns. After all, these angels are also business people. They want to see their investments grow, but high potential alone isn't enough. Angel investors also crave the assurance of a solid business plan. They want to see that you've mapped out your journey, that you have a clear vision of where you're going, and that you have actionable steps to get there. And last but certainly not least, angel investors are drawn to a passionate and committed team. They're looking for startups with teams that burn with enthusiasm for their product or service, teams that are ready to roll up their sleeves and do whatever it takes to make their startup succeed. Now, let's dive into the process of angel investing. The process of angel investing can be broken down into four main steps. First, there's deal sourcing. This is where angel investors actively seek out promising startups, often through networking events, pitch competitions, or even online platforms. Next comes screening. This is where the investor sifts through potential investments, identifying those that match their interests, expertise, and risk tolerance. It's a crucial step to avoid wasting time and resources on unsuitable proposals. Then we have evaluation. This phase involves a deep dive into the startup's business plan, team, market potential, and financial projections. The investor might also consult with industry experts or conduct due diligence checks to ensure the startup's viability. Finally, there's negotiation. This is where the investor and startup agree on the investment terms, including the amount of money to be invested, the equity stake the investor will receive, and any conditions attached to the investment. So that's the basic process. But what are the risks and rewards? Like any investment, angel investing comes with its own set of risks and rewards. On one hand, the risks are undeniably high. Since startups are in their nascent stages, many of them may not succeed. This could mean a loss of the entire investment for the angel investor. However, the flip side of this coin is the potential for substantial rewards. If a startup takes off, the returns can be exponential. Imagine being one of the early backers of today's tech giants. That's the kind of potential we're talking about. But it's not just about the money. Angel investors often take satisfaction in nurturing new businesses, helping them grow and seeing them succeed. To mitigate risks, angel investors often diversify their portfolio, spreading their investments across multiple startups. This way, even if some startups fail, others may succeed and cover the losses. Angel investing is not for the faint-hearted. It requires patience, a good understanding of the market, and most importantly, a willingness to take risks. Now please subscribe, like, and share. Thank you for watching.